confirmation candles. So we can call them CCs. Okay, CCs. In effect, today we are looking at candlesticks. We are looking at candlesticks because based on the knowledge I have gained so far, I have come to realize that if you really want to be profitable, two things you need to inculcate in your trading strategy. One of them is market structure, and then the other one is candlesticks. Candlesticks, very, very important. Your market structure and then your candlesticks. If you are able to put these two together, you are going to have an edge in the market. Okay, so I want you to write it down. Confirmation candles. Confirmation candles. We have what we call a chart. This you see over here, we call it chart. We call it chart. Okay, this is the chart of a particular currency pair, and the currency pair over here is the USD CHF. The currency pair we have over here is USD CHF. Okay, so USD CHF. This is the market that you are looking at, and when you look at the chart very well, there are different ways we graphically represent this particular market. Okay, so we have types of charts. 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 Okay, we have types of charts. The first one we have what we call the bar charts. We are going to look at how they all look like. The second one, we have a line chart. A line chart. And then the third one, we have candlesticks chart. Okay? Candlesticks chart. So these are the three basic types of charts we have. Okay, they are the representation of the market, the graphical representation of the market. We have so many of them. As we speak to you right now, there is something we call Renko. There is another chart type called Renko. There is another chart like Hekinashi. So many of them. But the basic ones that is common to every trader are these three: the bar chart, the line chart, and then the candlesticks chart. Okay, we are not going to do history over here. We want to go straight to whatever we want to do. Now, if you want to know these charts we are talking about, the ones that you are seeing over here, these things you are seeing over here, okay, you can see it is the market is being represented by some things over here. All the things you are seeing over here, we call them candlesticks. So this is the candlesticks chart. This chart is a candlesticks chart. Okay. Now let's look at how the line. Let's look at how the line chart looks like. The line chart like this. This is the line chart. You can see that it is a line. The market is being represented by lines. So you can see it is a line that is moving. So this is a line chart. Okay? This is a line chart. Then let's look at how bar chart looks like. We are not going to go deep into these guys, okay? Look at how the bar chart looks like. So this is a bar chart. This is a bar chart. This is a bar chart. We are not looking at bar charts today. So I will use the bar chart to explain something to you. Move forward. But we are not looking at the bar chart. And then, as I said, the last one is the candlesticks. So today we are going to focus on candlesticks. Okay? We are focusing on candlesticks. All right. So let me go back to my board and show you what we are talking about, or how to be able to read candlesticks. How you be able to read candlesticks. Okay. So the market is being represented by candlesticks. Okay? Candlesticks. Up. The market is being represented by candlesticks. There are two types of candlesticks. So we have two types of candlesticks. Two types of candlesticks. Okay? The first one, we can talk about the bullish candlestick. Bullish candlesticks. The second one, we can talk about the bearish candlesticks. Bearish candlesticks. Don't go. You said my screen is not changing at your end. Please check your network. Check your network. Okay. So there are two types of candlesticks. We have the bullish candlesticks, and then we have the bearish candlesticks. Okay, so we want to look at the bullish candlesticks, what the bullish candlestick looks like. Okay, so bullish candlesticks. Bullish candlesticks. When you take a bullish candlestick, the first thing that should come into your mind is a bullish market. Now, if it is a bullish market, then you know that in a bullish market, the market is going up. So a bullish candle is the candle that is going up. Basically, a candle that is going up. Okay, so the candle looks like something like this. This is a candlestick. What you are seeing over here is a candlestick. Okay, and this candlestick you are seeing over here has parts, or it is made up of various components. Now, when we talk about a bullish market, the market opens at a lower price point and then it goes up. Every candlestick starts with an opening price. So we have the open price, and then when it opens, what will happen is that the market will move the volumes that are coming in. Now, when volumes are coming in, this particular candlesticks has the probability of going down. So what will happen is that it will make a low point. And then after it has made a low price point, if it is indeed a bullish candlestick, then it will go up and then make a high. Follow, please. If it is indeed a bullish market, then enough volume will come into the market that will push the candlesticks to go high. So it will create a higher price. And then after it has created a higher price, based on the time frame, if the time frame you are in elapses, okay, that particular candlesticks will now give you a close. So, where do we identify these open, low, high, and close? The candle you are seeing over here is a bullish candle. And as I said, a bullish candle will open from a lower price level. So this particular price level here is your open. And then when the candlesticks opens, okay, it will make what we call a low. So this particular point is a low. Let's represent the open, low, high, close with letters. The open should be O, our low should be L, our high should be H, and then our close C. Now we have our open, we have our low, and then if indeed the candlestick is a bullish candle, or the candle is going to close as a bullish candle, then it is going to go up. Okay? When it goes up, it is going to make a high. So this particular point now becomes your high. And based on the time frame you are in, when that time frame elapses, okay, the candlestick is going to close. So when it is closing, it is going to close at this point. So a bullish candle is going to make an open. You are going to get a low, then you are going to get a high, and then you are going to get a close. So first, this is number 1, this is number 2, then the high number 3, and then the close will be number 4. Take note of that. This is a bullish candlestick. Now, I want to explain other components of the candle. Now, when you take the distance between the opening and the close, okay, the opening and the close, we call that distance the body of the candle. The body of the candle. So now we are looking at the anatomy of a candlestick, okay? If you're a science student, you understand it better this way. The anatomy of a candlestick. Okay. So, the distance between the opening and the close, the virtual volume has come into the market, then your reference should be the body of the candle. Please follow. Please follow. Okay. Then, let's also look at other things that you need to know about the candlestick. This is a bullish candle. The distance between the open, okay, the open and the low, you can see that it looks like a stick. it looks like a stick. That distance is called wick. It's called wick. Okay, it is called wick. The distance between open and the low, if you can see it like a stick, we call it wick. The same way, the distance between the close and the high, okay, it also looks like a stick. So that side too is also called a wick. Anatomy of a candlestick. Anatomy of a candlestick. Okay, so this is the label. Okay, this is the parts of a bullish candlestick. The parts of a bullish candlestick. And each of the parts communicates a message. Each of the parts of the candlestick communicates a message. Okay? The first, the body of the candle speaks of the actual volume that has come into the market. The actual volume that has come into the market. Take note of that. The distance between the open and the low, we are saying that it is called a wick. What does that mean? I want to explain what the wick means right now. The wick below over here, okay, speaks to the fact that when the market opened or when the candlestick opened, okay, there was some oppositions that met the opening of the market. And we have said that when you are trading, there are two things over here. We have the bears and then we have the bulls. Okay? The candlestick we see over here is a bullish candle. Now, at the opening, the moment the candle got opening, it was met with an opposition. So it was met with bear pressure. And the bear pressure, we are saying the bears are those selling. So at this particular point, the market was met with what we call selling pressure. Pay attention over here. Selling pressure. Selling pressure. Selling pressure. A wick below the candlestick means that there was some form of selling pressure. In other words, the bears decided to push the market lower. However, because they were not strong enough, because the bears were not strong enough, they couldn't hold price. They couldn't hold price. So the bulls were able to take over price again. They were able to take over. They were able to take over price again. Okay? And then the market now started going up. Now, let's look at the upper wick. The upper wick. What does the upper wick speak of? The upper wick is the distance between the close and the high of a bullish candlestick. We are looking at a bullish candlestick over here. What does that wick communicate? The wick is saying that when the market started going up, okay, within that time frame, the bulls wanted to close the market at a higher price. That is the high. The bulls, they wanted to, in a way, close the market at a higher price. Okay, so the bulls were able to push market up. They were able to push the market up to a higher point. However, when they got to a higher point, they were also met with opposition. So the bears met them again. And at that particular point, they rejected that higher price. So what happened was that they were able to push price down. So at this point, we are saying that there was some form of what? Rejection. Some form of rejection. You may be hearing some of these terms as we start trading properly. So this is what the candlestick speaks of. A week below is saying that the bulls wanted to push price. They were not strong enough. The bears were willing to push price lower. The bears. I mean the bears, okay? They wanted to push price lower, but they were not strong enough. Therefore, the bulls were able to take price up. They were able to take price up. And when they took price up, they took price up to a higher point. And at that particular point, they were also met with the again. Let's reject at this point. So when you take a bullish candlestick, these are some of the things that you have to know. Okay, we have the opening as number one, then it will make a low, and then the activity starts came in, will be, then finally it will close. Base the time frame. So this is the anatomy of a bullish candlestick. What we are going to do today is confirmation candles, but we have to know what candlesticks are. And we have to be able to identify the types of candlesticks, able to identify them and trade them accordingly. Okay, you can take a screenshot of this. I want to go to a bearish candlestick. So let us put it in this way. Candle forms. So this is the equation, or let's say this is how it is going to look like. A bullish candle, so we have open, and then we are going to have it to make a low, and after it has made a low, it is going to make a high, and then after the high it will close. So this is a bullish candlestick. It will open, makes a low, makes a high, and then close. Open, low, high, and close. Type that in the chat box for me. Open, low, high, close. Bullish candle is equal to open, low, high, close. I want to see that in the chat box. I want to see that. Type it. Let's go and close. I want to see that. Okay, thank you. All right, so that is a bullish candlestick for you. A bullish candlestick for you. Okay. Let me go to the chart and then show you a bullish candlestick. Okay. Let's go to the chart and see what I am talking about. Okay, so let's see over here. We are saying that with a bullish candle, this is what happens. Let me say that our bullish candles, okay, here our bullish candles are the white ones, are the white candles. So we want to identify them. All right. So look over here. We are identifying the bullish candles. So all the white candles you are seeing are the bullish candles. Now let's take this particular candle. This particular candle you see over here. This one. Okay. You can see that it started from a lower point. Okay. So this is our opening. Then it made a low. So this is a low. And then it went up and made a high. And after the high, it now gives us a close. Okay? So this particular candlestick you see over here is a bullish candlestick. And we are saying that when you take that particular candle, okay, the candlestick very well, you are going to see that it opened over here, it made a low, it printed a high, and finally gave us the close. So this particular candlestick you see over here is what we call a bullish candlestick. Okay, a bullish candlestick. All right. Now we are saying that from the opening from the opening, okay, to the close is the body, okay, and then from the opening to the low, we have what we call wick. I know that after we are done with the bullish, the bearish wouldn't be difficult. And then from the high to the close to, we are having another wick. Okay? We are having another wick. Now, we have also said that the wicks below is talking about the fact that, sorry, we are dealing with this candle. It's talking about the fact that when the candle opened, it was met with some form of selling pressure. Selling pressure. Okay? Some form of selling pressure. Which means that the bears wanted to push price lower, but the bulls were stronger than the bears. So they were able to take over the market. That is why we have the wick. And then we are also saying that when price now made a higher point, okay, the bulls were willing to take price higher. However, they were also met with some form of opposition. So here we are saying that there is some form of what? Rejection. The bears rejected the market from going higher. They opposed that. So this you see over here, is what we call a bullish candle. And you can see it everywhere. All the white candles. You see that this particular one here, market open over here, then it gave us a low. You can see that the low is very, very, very small. Look at the low over here. Very, very small. Okay? You can see that the low is very small. The low we have over here is very, very, very small. All right. And after it gave us the low, it then gave us a high, and finally it closed. So this is a bullish candlestick. So all the white guys you see, you can see the same thing happening. It opened over here, gave us a low, it gave us a high, and then closed. Now, let us now go into the wicks. Okay? Let us go into the wicks of a bullish candlestick. Look at what we have over here. The market opened over here. This is opened. We have a low. We have a high. And then market closed over here. So this particular candlestick you see here, what is the candlestick telling us? Before we go into a bearish candlestick, what is this telling us? What it is saying is that when the market opened, okay, when the market opened, there was some form of selling pressure. So the bears pushed markets down, but they were not strong enough, and the bulls took over. When the bulls took over, look at what happened. When the bulls took over, they were able to push price higher. However, when they got to the higher level, price was rejected. A very strong rejection. Very strong rejection. Okay, so this you see over here is saying that there is a very strong rejection. Strong rejection. Strong rejection. That candlestick is saying that there was a very strong rejection, okay, by the bears. So when you see a very strong rejection like that, it should tell you that the bears are strong now. They are strong. Okay? You can see the wick is longer, or the wick is, yes, let's say the wick is longer than the body. The upper wick is longer than the body. Okay? The upper wick over here, relatively, you can see This is longer than the body. So at this point, when you see something like that, you can say that the bears at this point were strong enough to push price to this level. And it also communicates that at that particular point in time, because of that strong rejection, there is going to be a reversal, possibly. And that is what happened. Okay. All right. Let us now go into a bearish candle. Okay, a bearish candle. The anatomy of a bearish candle. Let's go back to our board. We are now looking at bearish candles. Bearish candles or candlesticks, however you call it. Bearish candlesticks. We are looking at the anatomy of a bearish candlestick. So this is how a bearish candlestick look like. The same drawing. Okay, but this time we want to color it like this. So just to show that this is a bearish candle. So with a bearish candle, this is what happens. It opens at a higher price, so this becomes the open. And then when it opens, it will go up, okay? And that becomes the high. So this is 1, then it will make 2. Then after it has gone up higher, if the bears are strong, remember we are dealing with bearish candles. So here we are looking at the bears, and the bears are the players or the party that pushes price lower. So if they are strong enough, then they are going to push price lower. When they push price lower, the first thing they are going to do is they are going to send price to a lower price level. So at this point, okay, becomes the low. That is the lowest level that they can get to. The lowest level that they can get to. I'll answer your questions. Julius, you've asked a question. Okay. Then after they have pushed price lower, what is going to happen is that at that particular point, you can see per the time frame, when the time frame elapses, definitely price is going to close. So price now close over here. Let's look at the other things that we have spoken about already. The distance between the opening and the close, as we said, is the body. The distance between the opening and the high over here is called wick. The distance between the close and the low here too is called wick. Are we together? So this is an upper wick and this is a lower wick. What is the upper wick telling us? They moved price to a higher price point and they were met with opposition from the bulls. Okay, so the bulls rejected. The bulls wanted to push price higher. When price opened over here, okay, the bulls wanted to push price higher. However, the bears were strong. So at this point, we are saying that there was some level of buying pressure. Okay, buying pressure or intimidation. I like to use intimidation. So Here, the bulls intimidated the bears and they sent price higher. However, the bears were strong. The bears were stronger, so they were able to push price lower. And when they pushed price lower, they took price to a very lower point. However, at that point again, they met the bulls. So the bulls said that, okay, we are not going to allow you to close price at that lower level. Therefore, when the time frame elapsed, okay, the bulls succeeded in pushing price a bit higher, and it closed over here. So, with the bearish candle, this is what forms a bearish candle. First, it will open up at a higher price, at a high, let's see a high, and then it will move up, okay, and create this high. After that, if indeed it's a bearish candle, price is going to drop lower, and then it will create a low. Then based on the time frame, when the time frame you are in elapses, then it is going to close. So for a bearish candle, we have open, high, low, and close. Open, high, low, and close. So write it in the chat box for me. Bearish candle. Write it in the chat box for me. Bearish candle is equal to the open, high, low, and close. Write it for me. Bearish candle. Bearish candle. Thank you. All right. Someone is asking, why are they termed as bears and bulls? Who can answer him for me? Because we have done that already. Why are we terming these two players as the bears and the bulls? Somebody who is ready should unmute him or herself and tell me what the answer is. Why are we saying that? Why are we saying that we have bulls and bears? Who are the bulls and who are the bears? Somebody should talk to me. Who is ready to answer that question? Okay, Julius, since no one is ready to answer, I will answer it myself. Now, we use two animals to represent the economy of the currency pairs, okay? We use two animals. The base currency, we use the bulls to represent the base currency. And then we use the bears to represent the economy of the quote currency. You should know your base and quote. We are using the bulls because if you watch any documentary, I think one of our guys made this analogy and then he put it on the platform, very perfect one. If you watch many documentaries about bulls, what happens is that when they are fighting or when they want to fight their enemies, what they do is that they will put their horns down, okay, and then they will kick their enemies up. So if we are saying that we have three types of market: bullish market and then bearish market. We are saying the market is bullish because the market goes up. However, because before it goes up, it will start from a lower price point. That is a bull, like how a bull fights. A bull will go down before it will kick its opponent up. So before it goes up, it will now go down and kick the opponent up. Then the bear if you know what a bear, how the bear fights, I think we can liken the bear to maybe a goat or something. You see, when goats are fighting, they will stand on their legs and then kick their opponent down. Okay, they kick their opponent down. So in those times, they wanted to know how they wanted to use animals to represent the economy of the currency pairs. And they are saying that the way an upward market moves, it moves like the way the bull fights. Therefore, if the market is going up, we can say that the market is bullish. And if it is bullish, then the bears are in control. And the way the market goes down, it goes down like the way the bear fights. The bear will now stand on its feet and then it will kick the opponent down. Okay? And because of that, that is how the market also moves. If the market wants to fall, it has to go up before it falls. So the way the market, the downtrending market looks like, it looks like how a bear fights. So we can now say that a bearish market, we can now say a downtrending market looks like a bear, like the way the bear fights. So we can say a downtrending market is a bearish market, something like that. So they are the two animals that they use to represent the economies of the base and then the quote currencies that we have in a currency pair. All right. Thank you. All right. Now, so this is a bearish candles. We are now through with the anatomy of the two candles that I want you to understand. Let's go to the chart and see if we can get some of the bearish candles. Let's look at some examples of bearish candles. I want to share the chart and then we look at bearish candles. Okay. So when you look at the chart over here, our bearish candle is the one in is the color brown, pink, or what? What is the color you see over there? Please tell me. What is the color you see over there? Is it brown? Is the color brown, pink, or what? You are welcome, Julius. You are welcome. What color do you see apart from the white? Bismarck is a media. I'm seeing red. Hey, another person is saying wine. Pink. Okay, so however you are seeing you are seeing the candlestick. Okay, these are our bearish candles. So let's look at the anatomy of these candles. We are focusing on the candle over here. So this is the candle we are focusing on. The bigger candle over here. Someone is also saying brownish red. Yoyate. Thank you. Okay, so look at how the market now moved down. Okay, so when you look at the candlesticks, sorry. When you look at the candlesticks, the bearish candles are the ones that are either wine, brown, or however you are seeing it. But that is our colors. You can see that it started from this level. So this level is the opening. And then it was met with some level of buying pressure. Okay, buying pressure. So that buying pressure took price higher. So this is the high. And then, yes, still, the bears were strong. They were strong enough, so they pushed price to a lower point. So they pushed price up to this level. So this is a low. And based on the time frame, when the time frame elapsed, okay, they met the bulls again. So when the time frame elapsed, market closed over here, or price closed over here. So you can see that we have 1, the opening, 2, the high, 3, the low, and then 4, we have the close. So you can see that with all the bearish candles. When you look at this particular candle, the bearish candle over here, you see that it opened over here, but they were not met with any other pressure. It means that the bears were having enough strength that the bulls could not do anything about it. So here, at this particular point, we are saying that the opening and the high are the same. Okay? The opening and the high are the same. And after price opened, definitely it made a high. But here the high and the opening are the same. It now went down lower. And it was able to make a low, and finally it closed over here. So this is a bearish candlestick. So you can see that this is our opening, and then we had a low, we had a high, a very small high over here, and price was able to make a low and finally a close. So that is why this particular candle here is bearish. And we have also said that the distance between the opening and then the close is the body. And the body speaks of the volume that has come into the market. The upper wick for a bearish candlestick, the upper wick, okay, we are saying that it is called some form of buying pressure or buying intimidation. So the bulls intimidated the bears. However, the bears were stronger, so they were able to push price lower.